Hey guys, today we are changing it up a little bit. If you notice over here, you see a money market graph. And in the past week, we've been talking about monetary policy and how it affects the money market graph. Well, we've kind of neglected the money demand curve. We've talked about what shifts money supply, the buying and selling of bonds, but we haven't talked about money demand. And so today, that's what we're talking about. And so if you are taking notes and you want to title your note something, you can title it either Money Demand Shifts or Automatic Monetary Policy. Okay, so we have talked about fiscal policy a few weeks ago, talking about automatic fiscal, like how taxes and government spending change on their own with like tax brackets or welfare payments and things like that. Well, same thing's true about monetary policy. Even if the Federal Reserve decides to not do any of the monetary policy tools, it will naturally adjust. So it kind of fixes itself with automatic monetary policy. So let's talk about what money demand is. Remember, it's on the money market graph, which is right over there. It's downward sloping, labeled MD. Well, what shifts it? Think about every time you reach for your wallet to buy something is changing money demand. Or when you're not buying something, that's also a change in money demand, just less of it. So anytime you reach for your wallet, you're demanding money to buy things. So whenever you buy things, and not just you, but consumption, you buying things, when businesses buy things, when the government buys things, or foreigners buy things, and they need our money to do so. Basically, the shifters of aggregate demand are the same shifters of money demand. They shift the same direction for the same reason. So every time in the past that we've shifted aggregate demand to the right and aggregate demand to the left, just in an alternate universe, money demand was also shifting the same way. So what does that do with monetary policy? Let's say that we're in a recession. On an aggregate supply and demand graph, recession looks like this, which you guys should know. LRS is way over here. Boop, 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 boop. So in a recession, you know what's true? Let's see here. We have high unemployment. Lots of people don't have jobs. People aren't going out and buying things, and that's the big problem. People aren't buying anything, which is businesses aren't making money, and they have to lay off people, and then there's even less buying if no one has jobs. It's a vicious cycle. But also what's true is when people don't buy things, that affects the money market graph. Here's our money market graph. Let's say that even though the Federal Reserve should buy bonds to expand the economy in a recession, let's say they don't for whatever reason. And that it's like money supply will stay the same because they're not doing policy, but money demand is still going to change. And so when there's less spending in a recession, less spending means less money demand. People are reaching for their wallets less if they're not spending anything. So, if you're not buying that car, you're not buying that TV, you're demanding less money. You're reaching for your wallet less. So money demand shifts to the left. Well, look what happens to interest rates. The nominal interest rate lowers if you guys are not buying anything. Interest rates naturally fall without the government doing anything, without the Federal Reserve doing anything. And that right there, if interest rates are low, now it's cheaper to take out a loan. It's cheaper to buy that pizza oven for your business. It's cheaper to your credit card payments are going to be cheaper. If there's less interest rates, aggregate demand is going to shift to the right. Did the Federal Reserve do anything? No. It's just you guys chose not to buy things that naturally lowers the interest rate. And that right there, we have automatic, technically, this is automatic expansionary monetary policy because money demand is going to change the interest rate. And when there's less money demand, that lowers the interest rate and then boosts spending if it's cheaper to take out loans. It works just the opposite. Let's say that there is a period of inflation. And here we have an inflationary gap on an aggregate supply and demand graph. Inflation. In a period of inflation, what's wrong is that people are spending way too much money. There's way too much spending. They're reaching for their wallet more than they should be. And they're reaching for their wallet because, like, oh, I thought it was $5. Oh, no, sir. With inflation, it's now $10. So they reach for their wallet again. So they're reaching for their wallet because prices are so high. And so here we have our money market graph. And inflation, there's more spending, or at least maybe you're not spending more, but you're spending like you're not buying more things, but if you even buy the same amount of things because they're more expensive, you are going to be spending more money, which means there's more demand for money, more money demand because of high prices. And that money demand, as people reach for their wallets more, increases money demand, shifts it to the right, money demand too. And look what happens to interest rates. Interest rates are going to go up on their own, even if the Federal Reserve decides to not do any policy. You guys buying more things increases interest rates anyway. And so with higher interest rates, now it's more expensive to take out a loan. It's more expensive to swipe that credit card. It's you can't afford to take out a loan to buy all those pizza ovens for your pizza shop. And so aggregate demand falls as there's less spending because of now higher interest rates. And there, the economy fixed itself. So not only do we have fiscal and monetary policy when like Congress does something for fiscal or the Federal Reserve does something for monetary, even if they don't do any of those things, we still have automatic fiscal and now automatic monetary. So know that if the Federal Reserve does do policy, money supply will shift. But if the Federal Reserve decides to not to do any policy, then money demand will. Okay, and it shifts in the same way as aggregate demand. So if you know your aggregate demand shifters, it's the same thing as money supply shifter or money demand shifters. Aggregate demand, money demand, same thing. So that's all today. This was just like what shifts money demand, and it's just a change of aggregate demand. So here's that money demand curve again. Just to wrap up, money demand. This is more spending. Money demand shifts to the right, less spending. Money demand shifts to the left. Okay. And that right there, that little shifter right there is what allows automatic monetary policy to happen, even when the Federal Reserve doesn't do anything. All right, guys, have a great afternoon. Quick video, and that's it.